Good morning and welcome to Charting the Markets on Friday, the 10th of February. Overnight, the US market came off for the second consecutive day on worries about the monetary policy being still quite tight in the US. And as investors fled equities and moved into bonds. In Asia overnight, the Asia Pacific index also dropped by less than 1%, like most of the US indices. And we also saw overnight Chinese CPI growth come in weaker than expected, and PPI was also weaker than originally forecast. But Chinese inflation has now risen to a 3-month high. And in Japan, we saw PPI data come in at 9.5% for January. And in Australia, we had the Reserve Bank of Australia raising its inflation outlook, all of which put pressure on European equity markets overnight. And before we look at the FTSE 100, I'd just like to mention also that UK GDP data, which was highly anticipated by the markets in the UK, came in flat in the fourth quarter compared to the previous quarter, and it rose by 0.4% year on year. So we're not in a recession at the moment. Now, if we look at the daily chart of the FTSE 100, what is interesting here is that the latest all-time record high we made yesterday, just below the 7,950 mark, was followed by a sell-off earlier today, where we dropped back down towards 7,870, but then we recovered, and we're currently testing the 2-week support line we've had here in place since late of January. Now, what is interesting from a technical perspective, and we're seeing this on all European equity indices, is this negative divergence. Basically, what it means is that the latest high we saw this week has not been confirmed by a higher high on the relative strength index, which is here at the bottom of the chart. So when you have the RSI pointing lower, the relative strength index pointing lower, whilst the market's making newer high pointing up, that is called negative divergence. In about 70% of cases, it does lead to at least a short-term consolidation against the trend taking place, or sometimes even to significant reversals. So what I'm basically saying is that one might be interested in tightening one's profit-taking stops on long positions, because it is quite likely that we might now peter out, especially since next Tuesday we will see the US consumer price inflation data come out, CPI data. And if that comes in worse than expected, you can expect equity markets to come off quite sharply. But we'll have to see what the market actually does. So from a technical perspective, this negative divergence is showing us potential weakness. As you can see here, every time we do come off, buyers come into the market and push the market higher again. So for now, the FTSE 100 is holding, but this previous support line is now acting as resistance as we speak. So we'll have to see whether we can stay below 7,948, yesterday's high on this daily financial bet, and if so, fall below today's low at 7,869, in which case we are likely to see a sell-off take us back, not just to the mid-January high at 7,811, but possibly even to the late January low at 7,708, where you can also see the October to February uptrend line come in. Now, the same pattern you can spot on the German DAX 40 contract. And as you can see here, we made this gravestone Joji formation yesterday, where we made a new 1-year high, rallied to 15,656 on this daily financial bet, and then came off. And then this morning, we are currently testing the January to February uptrend line. We slightly fell below it, and yesterday's low giving us a sell signal from a technical perspective earlier today, but then bounced off again and are currently holding above this uptrend line. But the story is the same, because this latest high yesterday, the 1-year high, was not confirmed by the relative strength index, which has made a lower high. We can see negative divergence on this chart, and that potentially points to a consolidation phase, taking us back to a Tuesday's low at 15,272. And if that were to give way back towards this key support area between the mid and late January lows, between 14,992 and 14,904, So this will be the interesting chart to watch in the next few days because of this negative divergence. Will we see a reversal or not? And looking at the 50 largest stocks in Europe and the Euro Stoxx 50 daily financial bet here, we can see the same pattern once more, where we have a higher high. We made a one-year high yesterday at 4,276, taking us back to levels last traded in February of 2022, but then formed this gravestone doji pattern. And today briefly fell below it and are now testing this 2023 breached uptrend line, which currently acts as resistance. As long as that's the case at the end of the day today, the odds are that we might retest the low seen on Monday at 4,186, and failure there might take us back down again towards the mid to late January lows, all the way down to 4,092. And this is the critical level to watch out for from a medium-term perspective, because if we were to fall through that low on a daily closing basis, especially on the weekly closing basis, then that would probably mean that we have ended this strong upsurge we've seen since the beginning of the year and may head back down again towards the early January lows and give back quite a lot of those profits going forward. But we'll have to see what happens with regards to equity markets in the next few days. The US dollar has risen last week quite sharply, but then started to sort of drift off again. And what is interesting is where the US dollar basket actually failed at from a technical perspective, because if you look at the US dollar basket, you can see that we rallied all the way from the 101.57 daily financial bet low we made at the beginning of this month into this key resistance area I've been mentioning for several weeks now, between 103.08 and 103.66, basically the lows made in early and mid-December. And this resistance area has actually capped the advance that we saw by the dollar basket on Tuesday when we made this high at 103.63, and are now basically trading back below that resistance area. So this is really key for the medium-term trend, because what it means is that as long as this caps, we remain, as you can see here, in a clearly defined downtrend channel, and the US dollar remains in a downtrend. Having said that, we have now broken through this several months long downtrend, are trading above it, and are testing, after all, this key resistance area. Even though we've come back over the last few days, we are keeping we keep probing this resistance area. And if we were to close above 103.63 and also 103.66, the early December low, then the odds are that we are actually in the process of forming a kind of bottom. That could take us back up again towards the 104.56 to 105.49 area, the early to mid-December highs. So that'll be interesting to see whether we can break that resistance or not with regards to the US dollar basket. Now, the US dollar basket is made up of 57.6% of the euro, and you can see here euro dollar having come off by over 2% very sharply last week, and this week basically just traded in relatively low volatility, as you can see here, above the low we made on yes, it was Tuesday, 106.70. So here we are just trading sideways now, but going forward there's pretty good resistance, which was support previously between 107.15 and 106.66, so basically between the late December, early January highs and also the mid-January low. So as long as we stay below there, the reversal is actually still intact with regards to euro dollar. We could slide further all the way down to the January low at 104.84 and also the early December low at 104.44. So that'll be interesting to see whether we can bounce back or not and then break through 107.66, in which case we could retest that breached resistance area now, which was the previous breached support line. So now it's become a resistance line at 108.90. But so far it looks more probable that we will just trade sideways and then have another attempt at heading back down again, meaning further strength for the US dollar. Moving on to the yen, we can see here that dollar yen is also coming off again. And this was also our trading the trend, which we did this Wednesday, in that we think that we have formed an ABC Elliott wave zigzag correction here, which ended at 132 yen and 90 sen back on Monday, and that we are likely to head back down again all the way to the January low at 127.23 and lower towards 126.50 in the days and weeks ahead, as long as we stay below this key resistance area, taking us back to 133.63, the early December low, and 134.77, the early January high. So that is really key resistance for this currency pair, and we expect short-term the US dollar to continue to slide in the day, the dollar yen, sorry, and the US dollar to rise. So dollar yen to slide and the dollar to rise in the next few days. Commodity markets have also been affected by the rising dollar last week and haven't really recuperated that much of their recent losses as the US dollar started to stabilize. And we can see this on this daily chart, daily financial bet also, of the gold price. And as you can see here, gold has come off its $1,959 per troy ounce high made at the beginning of February, and has so far slid to $1,853 per troy ounce. And as you can see here, we made a short-term attempt of heading back up again, but that failed yesterday at its high at $1,890, with the price of gold slipping once more. Now, where could it get to? Well, basically, you've got this high here from the late December high, and also the low from the 5th of January. And that basically comes in between 1,833 and 1,825. So that would be our next possible support area. And as you can see here, we've seen quite a lot of highs going back into December, which might now, going forward, act as support for the price of gold. For the bulls to be back in control, we really would need to rise above yesterday's high at 1,890. Only then could we attempt to see further upside with regards to the gold price. Moving on to Brent crude oil, what we can see here is that the price of Brent has once again bottomed out, this time at $79.04 on this daily financial bet at the beginning of this week, and we are now heading back up again towards the top of our sideways trading range, which we have been in since December. And that takes us back to the $87.99 low seen in mid-October. And it's a resistance area made up of highs made in December and also January, and late January highs basically between $87.99 and $89.35. So as with the US dollar index, and the dollar basket, what we need to see here is a key break of this resistance area. And basically that resistance area, as long as it caps, we could be trading sideways again. But if we were to break above $89.35, then we would form a bullish reversal here. And that could take us all the way back up to the 200-day simple moving average at $95.43. So interesting times ahead with regards to the price of Brent crude oil. I'd like to finish up on today by looking at a daily chart of copper on this daily financial bet. You can see that the copper price has come off from its mid-January high at $9,951 and taking us back down to $8,809, above which we are sort of range trading. Now, it looks as if we're holding above this key support area here between the November and December highs between $8,629 and $8,593. And as long as that holds with the November to February uptrend line, which currently comes in around $8,670, the uptrend from a medium-term perspective remains intact. And we may have a retest of the previous highs seen in January. But short term, we really need to hold above $8,809 for further upside to be seen. If that's not the case, it's likely that we're going to retest that key resistance area, which has now become support area between $8,629 and $8,593. Thank you very much for watching Charting the Markets with me, Axel Rudolph. Please feel free to follow me on Twitter. My Twitter handle is @AxelR_IG.